Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 114, I'm going to continue my end of year series that I introduced yesterday, where we're going to continue to walk through some of the policy and background, at least in terms of education, behind the various transfer taxes. We started with the gift tax yesterday. Today we're going to discuss the estate tax. Now, as always, this presentation is not intended to substitute for legal or tax advice, and it's provided for educational purposes only. And as an additional caveat, as I mentioned in yesterday's presentation, the views here are really just the parallel thinking shortcuts I've developed in my mind. They're solely the views of Griffin Bridgers and don't reflect actual policy documents or research, but instead, these are designed to be kind of the talking points that I can cherry pick when explaining the estate tax to clients and students. So, the estate tax has been the subject of much dispute throughout the years. There's always debates about whether it's necessary or whether it should be around, and you can find people in all sorts of camps. But policy arguments and political arguments aside, the estate tax, much like the gift tax, is generally designed to shift the burden of taxation on wealth transfers at each generation from the recipient to the estate of the decedent. So that's reflected in a number of things we're going to look at, like with the income tax, how there's an exclusion from gross income for non-IRD inheritances, as well as a step up in basis for assets included in the decedent's gross estate. We'll look at those a little bit later on. Now, I want you to contrast this with some of the systems that you see in a lot of other states and countries where there is an inheritance or death tax, and it could even be at the regional or local level in a number of countries, or even the municipal level. But in all of these cases, what happens with those types of taxes is that sometimes the burden of taxation for wealth transfer can be shifted to the recipient or kept with the recipient instead of being imposed on the estate of the decedent. And with all of these taxes, liquidity is always an issue because, as we're going to see, this is not dependent on the category of asset. It's really dependent only on the value of the asset. Now, another option you could have is that you could have a deemed disposition tax, which is the type of system they have in Canada, where at death, the decedent's assets are deemed to be sold for fair market value. So this essentially, it's like an estate tax, but it generates an income tax instead of an estate tax that has to be paid by the decedent's estate. And the difference here from the estate tax is that the basis of property with a deemed disposition tax is not subject to that tax, whereas the basis of property is subject to estate tax, at least to the extent it's reflected in the date of death fair market value. And on that point, the tax base for the estate tax starts out being the gross estate. Now, this is all of the assets the decedent owns or is treated as owning at death, valued at their fair market value at date of death. Now, there is an option you could use called the alternate valuation date, which is 6 months out from date of death and really reflects a policy that they don't want to ding an estate that pays estate tax out of a shrinking value that was much higher at date of death. So if you had somebody who died, say, in 2007, 2008, when the market crash was going on, then if they had waited until the market was at the bottom to pay their estate tax, they would have been paying it from a pool that had been depressed by as much as 50 or 60%. So the alternate valuation date eliminates that, but it only applies where, one, there is an estate tax, and two, where the alternate valuation date not only reduces that estate tax, but also causes the taxable estate to be reduced, and that happens because the marital deduction could be offset or reduced as well. So there's some other deductions available. There's first economic deductions, which really kind of create the net equity value of the gross estate. That measure is known as is the adjusted gross estate. And these are actual economic expenses like debts, expenses, claims, so on and so forth. Then you have some deductions which are more policy decisions, for example, not to tax transfers to a spouse or to a charity. So because of that, you can get a marital deduction or charitable deduction, and there's also a deduction for state death taxes in that policy deduction category as well. Now, most taxpayer battles with the estate tax are going to revolve around one of two things. One is the valuation of the assets, because he can take discounts, and it's hard to really kind of nail that measure of what is the fair market value at date of death, because it takes into account the marketability, the control, lack of control, so on and so forth, and the effect on the overall asset value that might occur by selling it instead of holding on to it. And inclusion of assets in the gross estate is another issue that's popped up a lot, and we'll talk about that in a minute, with retained benefits or control. Now, there could be transfers by others that also get pulled back into the gross estate. Those aren't usually subject to dispute because the IRS is pretty clear on them. The only one that's really subject to dispute is where the decedent holds a general power of appointment, and where the decedent exercises a special power of appointment to trigger the Delaware tax trap. The other one might be if you transfer property and there's a marital deduction due to the application of the Q-tip election, then that property is included in the estate of the beneficiary spouse, even though the beneficiary spouse was never the owner of that property. So, much like the gift tax, there is a progressive rate table, but it's rare that you get to use the progressive brackets on that table because the 40% top rate kicks in after the tax base exceeds $1 million, and the applicable credit amount, which essentially exempts the first 11.7 million starting in 2 days of the tax base, practically means that the estate tax is going to kick in well past that $1 million, top bracket floor. So that means you're pretty much always going to be in the 40% rate, and it's not exactly a 40% rate. It's $345,000 on the $800 on the first million, and then 40% on the excess over that first million. But usually that's a wash with the applicable credit. Now, the exclusion, the 11.7 million, is really the subject of a lot of wrangling and political ploys and stuff like that. And that exclusion, especially in its current form, isn't necessarily part of the core estate tax policy, but is used, as I mentioned, as more of a political ploy, especially throughout the last few decades. Now, much like with the gift tax, there is an applicable credit to offset the estate tax that would be due on the tax base, but you can also get a credit for gift tax paid out of pocket during life, which can reconcile reductions in rates prior to death, and your exclusion upon which the applicable credit is based. Right now it's 11.58 million, it's going up to 11.7, but depending on what it is at the time of death, it can be increased in two ways. One is if the unused exclusion of your spouse is preserved through a portability election, that would be a deceased spouse, and if the exclusion is greater at the time of gift than at the time of death, and you use some of that greater exclusion, whatever portion you used could increase the amount applied to the applicable credit. Now, when it comes to the income tax, as I mentioned, inheritances are not subject to income tax unless they're income in respect of a decedent. That would be things like retirement plan assets, deferred payments, notes, things like that. Now, the step up in basis applies to all assets in the gross estate, whether or not those assets generate estate tax. And that's a change from the gift tax. And even though it's designed to eliminate double tax, there is kind of a double exclusion here in that you can get the step up in basis, which wipes out capital gain on the appreciation, and you can use it even if you're just getting it through the use of the applicable exclusion. So this is one of the biggest tax freebies out there right now. So for items of income in respect of a decedent, even though those are subject to income tax, that double tax is eliminated because there's a miscellaneous deduction to the beneficiary who receives that IRD for the estate tax generated by that IRD received. Now, when it comes to the gift tax, I did a lot of discussion on the ways these shoehorn together yesterday in terms of cumulative calculation. And just to kind of refresh your memory, keep in mind that you always keep a running cumulative total of your lifetime gifts when calculating gift tax and credits. And the same ultimate figure rolls over onto your estate tax return as a figure called adjusted taxable gifts. And that, along with your taxable estate, form the tax base upon which the estate tax is based before credits. The big difference between taxable estate and adjusted taxable gifts is going to be value. Taxable estate is taxed at date of death fair market value or at the alternate valuation date, whereas adjusted taxable gifts get that date of gift value. And there's also a marital deduction and charitable deduction for both gift and estate tax purposes as well. Now, as I mentioned, one of the big battles here is that you could have previously gifted property to which a gift tax was applied, but it could be shifted from the adjusted taxable gifts bucket to the gross estate bucket if the decedent retains control or a benefit that they still had at death, or that they released within 3 years of death, or a reversion that was held at death or released within 3 years of death. And essentially the effect there is that the gift tax freeze is lost. You now have to value those gifted assets at date of death fair market value and not date of gift fair market value. But in the hands of the beneficiary, it's important to note that the income tax they would incur if they turned around and sold that asset will be eliminated and offset by the step up in basis. So even though you have 40% tax on the appreciation, there is a downstream benefit that effectively makes that tax less than 40%. Now, gift tax that's paid within 3 years of death is brought back into the gross estate. It's rare that happens anymore, but it could. And unused exclusion of the deceased spouse, if preserved, is first applied as applicable credit to offset gift taxes. So, it helps to look at, if you're a widow, at your deceased spouse's estate and preserve that unused exclusion. Now, it's important to note that if you are a survivor who is widowed multiple times, you can only use the unused exclusion of your most recently deceased spouse. But that exclusion will be available to offset gift taxes, and if you use the first deceased spouse's exclusion to offset gift taxes, you won't be dinged for that. And that is it on the estate tax. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.